Here's how the dividend snowball effect works. You purchase shares of a company's stock. Once the company pays out its dividend, either monthly or quarterly, you use that payout to purchase more shares of the stock. Doing this will in turn increase your next dividend payout. As the cycle continues, your shares and dividend payout increase exponentially, creating a snowball effect that compounds through the life of your investment. It's like an MLM, but one that actually works. Warren Buffett is undoubtedly one of the greatest value investors out there, but he's also a very vocal supporter of dividend earning stocks and buy and hold investing. He once said, "Someone is sitting in the shade today because someone planted a tree a long time ago." The same invest and reward cycle is true for dividend stock investing. An investment today following some key principles will pay handsomely in the future. He was making a very clear statement that time and patience will water your dividend investments and help them grow to new heights. People call an investment strategy a strategy for a reason. Playing in the stock market is just that, playing. But we're not here to win some and lose some, so to speak. We're here to create a better life for ourselves and our family. And in order to do that, we need to have a strategy. I believe there are 5 key points to effectively building a dividend snowball portfolio. Together, they provide a sound strategy to secure a constant passive income that'll pay you year after year with little to no work past your initial investment. Let's take a closer look at these 5 key points. Point number 1 may seem very basic, but it's by far the most important and the one that takes the most time and effort in the beginning. Buy only good dividend growth stocks with a history of yearly dividend increases. And you say, "Thanks, Captain Obvious, but how the heck do I do that?" Well, there are many different approaches, but personally I use the following metrics. First, look for stocks with a starting yield at a minimum of 4%. If your yield's too low, it'll take too long to see a consistent return. On the other hand, if your yield's too high, there's a risk that the company can't maintain its dividend payments or shows low capital growth. Keep in mind the longer you have to invest, the lower starting yield you can afford to start with, but I like to start with stock in the 4% minimum range. Second, focus on stocks that have a 5-year combined annual growth rate, or CAGR, of dividend payments of 5% or higher. This is critical to ensure that the company has a history of not only paying its dividends consistently, but also increasing them every year. This is a game changer. We'll make sure we maximize our investments over the long term. Personally, I am for stocks with a 7% or higher CAGR. With proper research, this is easily achievable. And the last metric for finding good dividend stocks is to ensure that the capital gains for the stocks I'm reviewing also show a positive trend. Now that we know how to identify a good dividend stock, let's move on to point number 2. The second critical item of our 5 key points is consistency and contributions. You should contribute at least monthly to buy more shares and increase your holdings. Dividends are paid by the number of shares you hold, not the value of those shares. When you buy stocks for income or dividends each month, this approach is called dollar cost averaging. Dollar cost averaging will reduce the short-term volatility in the broader equity market. It's one of the best tools for an investor to build wealth over a longer period of time, which is exactly what we're doing here. Treat your investing as a budget item, and please be diligent in your contributions. Point 3 is reinvesting your dividends. You should make sure to reinvest your dividends each month. This is an effective way for long-term investors to really accelerate their dividend growth. Some companies allow you to do this automatically, and in some cases you must do it manually. Either way, it's an integral part of a robust dividend snowball strategy. Let's look at the following example that shows just how explosive dividend reinvesting can be. Let's consider an initial investment of $1,000 and a recurring investment of $500 per month, which is $6,000 per year in our portfolio. Remembering our dividend stock identification metrics from earlier, let's use a starting dividend yield of 4% and a compound annual growth rate on that dividend of 5%. We'll use 4% for the average annual share price appreciation as well. There are dividends that pay on several different schedules, but we'll assume quarterly dividend payments as that's the most common. We'll make a worst-case assumption that this is in a taxable investment account instead of a Roth IRA or something along those lines. And then let's project our return over a 30-year period. For this first scenario, I'll assume that we're not reinvesting our earned dividends. So after 30 years, we've invested $181,000 of our hard-earned money. We have a portfolio value of $339,753, earning a respectable $18,471 in dividends each year. We collected cash dividends in the amount of $193,788. While this is nothing to laugh at, let's take a look at what happens when we reinvest your dividends. Using the exact same investment strategy and only changing it to reinvest dividends, we can see that we now have a portfolio value of $705,744, and we're earning $38,375 per year in dividends, more than double the previous scenario. And remember, we used the same $181,000 investment over 30 years. That's a crazy difference. Now that we're excited about the potential, let's get a little more aggressive with our saving and investing with a second investing strategy. Let's say we use a $5,000 initial investment and decide to invest $1,000 per month or $12,000 per year. All other variables we previously used will remain the same. 4% starting yield, 5% compound annual growth rate, and a 4% capital gains return. Assuming that we do not reinvest dividends, after 30 years we've invested $365,000. Our portfolio value is $689,236, earning us $37,478 in dividends each and every year. We also collected cash dividends in the amount of $395,549. Now, let's take a look at what we see when we reinvest dividends just like in the first scenario. We now have a portfolio value of $1,441,574, earning us an amazing $78,387 in annual dividends on our initial investment of $365,000. That's a 294% return on our hard-earned cash. Yeah, baby! Yeah. As you can see, this strategy makes a significant difference to your future dividend payouts as time goes on. That is exciting. But wait, we have a few more things to make sure we're doing to ensure the Dividend Snowball reaches its maximum potential and busts through our goals on our way to financial freedom. Now, our fourth key point is often the hardest, but it's the true heart and soul of not only the snowball effect, but dividend investing as a whole. I know. This is the part that no one wants to hear, but it has to be said. You need to harness the power of time and exhibit patience. The Dividend Snowball investing strategy requires time, and the longer you can maintain it, the rewards really do grow exponentially. And last, but certainly not least, is critical point number 5. Start now. I can't stress this enough. Start now. Whether it's with $100, $1,000, or $10,000, start now. The sooner you invest, the sooner your earnings begin compounding. And we saw earlier how much time plays a part in your returns. As I said before, time's your friend in relation to the dividend snowball effect. And time you waste is time you never get back. As you can see, through the use of time and patience, you really can grow your dividends to the point you can live off those payments while never touching the principal. This provides a security that capital gains investors honestly will never know. While they're cashing out investments every year to the tune of 4 to 5%, dreading a potential market